Good evening, folks. This is Carl, your ticker guy, coming at you from Niceville, Florida. It is the 22nd, and this is your $700 billion mega bailout watch video update. Today, the Dow Jones Industrials were down huge, nearly 400 points. I'm sure you will hear commentary that people are afraid that the bailout might not pass. Well, MSNBC earlier this evening, I don't know if they're still running the article, was running an article that said that the market was afraid that the bill might pass. That is actually the accurate interpretation of the market's events today. Let's go through what happened here. The XLF, which is the financial spider, if you will, it's a way to buy all the financials in the broader market at one time, was down about 8% today. That's a very large move, and it is what led the broader indices lower. The NASDAQ and the Russell were also down big. Now remember, you're not allowed to short financial stocks right now. So for those people that say that the short sellers were running around driving down the price of all these financials, we now know that is a lie, because how can you possibly have these stocks down that sort of percentage if you're not allowed to short, if the shorts are responsible for it? To give you some examples, Wachovia Bank was down 11.4%, Wells Fargo was down 11.6%, and Washington Mutual was down a whopping 21 and change percentage points. National City was down almost 10%, and PMI was down 3.2%, which is a provider of private mortgage insurance. JP Morgan was down 13.2%. These are big moves, folks, and they came along with a liquidity collapse on the bid side, which is exactly what I've been afraid would happen with shorting banned. They really need to rescind that rule right now, because shorts, although there are a lot of people that hate them, they provide liquidity in the market and they provide support on days like this. Otherwise, you see the kind of thing that we had happen in Wachovia earlier today, where all of a sudden there was just essentially no bid at all and the price collapsed. Got that on the screen here for you. All right, let's go back to what else we know, though. Crude oil was up by the most it's ever been up in a single day. Now, about $20 of that move was short squeeze in the front month contract. And whether or not that translates through tomorrow, I don't have any way to know yet. But it was still up huge even without that monster short squeeze. Gold was up a little bit. Silver was up very significantly. Silver was up 7% on the day on the SLV ETF, which is a way to buy silver without actually taking physical delivery of it. So we also had an interesting thing happen in the bond market today. The 10-year bonds sold off during the time that the market was going down. And that's not supposed to happen, folks. When people leave stocks, they're supposed to go into bonds. So what did we actually have happen here? We had the market pricing in hyperinflation, or at least the start of it. In other words, the federal government's going to print money. Well, why would the federal government print money? Maybe because they're going to, the market thinks anyway, buy $700 billion worth of worthless assets? Yeah, that might have something to do with it. And oh boy, those oil traders loved that. The dollar got hit pretty hard too, and everything else related to it, all the commodities, went up hard. Every commodity on the commodities exchange was up today. All of them. So folks, let's pay attention to what Mr. Market is telling us, because Mr. Market is always right, even if a little schizophrenic. Mr. Market today said, you pass this bill, people's inflation rates, their cost of living is going to go to the moon. Cost of borrowing for the government is likely to go up substantially. This is the worst case scenario that I have been saying could very well happen. Guys, we can't spend this, we can't allow this authorization to go through without solving the trust problem. As you can see, the XLF, the financials in the stock market, aren't very impressed that the trust problem is going to be fixed. $700 billion or no $700 billion. They just plain old-fashioned don't believe it. And the bottom line here is, unless we get confidence back, we're just throwing money into a tornado. So in the previous video, you were given 3 specific steps that would restore confidence to the financial markets. I haven't heard those come up in the debate yet on this bill, but they need to, and they need to happen before we go buying up any assets. Is there a need for something like the HOLC? which was a Depression-era entity in the government that issued mortgage paper and made sure we had liquidity? Yeah, there might be. I'm not going to deny that. That's a very real possibility. But the Resolution Trust Corporation, which was our S&L era equivalent of that, got its paper from failed institutions. And Paulson wants to take it from ones that are allegedly sound, maybe by force. Now, granted, the Democrats in Congress, along with some of the Republicans, have said the bill as it was originally submitted ain't going to fly. And they have been wrangling over adding some protections for the taxpayer, adding some help for homeowners, and basically diddling around the middle. But nowhere are they taking up the fundamental problems, folks. And again, just to go through them briefly, you can go watch the other video if you want to hear the whole spiel. It's number one, balance sheet transparency. I need to be able to pull up a 10K or a 10Q on any company in the United States that has financial exposure and know what's on their balance sheet and how they valued it. Number two, CDS, credit default swaps. Those things need to be put on an exchange, and the ones that can't be backed by adequate capital need to be nulled out. If we need to pass a law to do that, we need to pass a law to do it. But we have to either prove capital adequacy to honor those, or they need to be nulled, because we have to snip the fuse on this bomb. If we don't, we're going to continue to go from bailout to bailout, and every time the argument is going to be, we're going to trigger all these things and the system's going to explode. And that argument has some merit, so we need to neuter that particular element of systemic risk. If we don't get it out of there, we're not going to solve the problem. And number three, leverage. I still haven't heard anybody come out and say, got to take that leverage down to 12 to 1, guys. Those three things have got to happen. We're not arguing about whether or not we can. We must. If we fail to do that as Americans, ladies and gentlemen, what's going to end up happening is that they will go out and they will throw $700 billion, $1 trillion, $2 trillion, $3 trillion into the tornado. The tornado will suck it up. The $700 billion or $1 trillion or however much it is will disappear, and we will be right back here. But we will be right back here with a monstrous inflationary bias, because the Treasury and the Fed will have to print that money to cover the $700 billion. Folks, you've seen what happens when gas prices start to skyrocket as a result of oil going sky high. You only thought oil was expensive this spring. It can get much worse. This time it isn't going to be about speculators or anything of the kind, or hurricanes for that matter. The season is thankfully getting towards the end. It isn't going to be about limited supply disruptions because a hurricane tore into some refineries. It is going to be about the fact that we are debasing our currency on purpose, and without purpose, and without effect. Solve the systemic problems, take the risk off the balance sheets. Force these institutions to tell the truth. Then, if we need to bail out homeowners, or we need to take some of this debt down from failed institutions, we can do it just like we did with the RTC. It would be very expensive, but the systemic problems will be solved. If we need an HOLC to provide liquidity in the mortgage markets, I'm not necessarily opposed to that. I think it may even be a really good idea. I think we have one, though. It's called Ginnie Mae. Wouldn't be a bad idea there. If the Treasury Secretary wants to buy up assets from failed institutions, I have no quarrel with it at all. In fact, it may be the only answer to get some of the debt off IndyMac's balance sheet, which is now owned by the FDIC, and other banks that are likely to fail in the coming months. But folks, coming in there with $700 billion and thinking that you're somehow going to solve the confidence problem, the market says it isn't going to work. The equity markets, they agree with me. Call Congress.